This is a rather special interview. I have Edward Karr of the American International Club with me, and we're turning to Bianco of Bianco Research to understand what is going on in the US. Why is the US economy not doing as well as we hear of? And what is going to happen with the Fed hiking rates? Edward, good afternoon. Jim, welcome.
Thank you.
Thanks, Nicolette.
So first, what is happening with the US data?
It's been a bit of a disappointment. The US data has come in probably a little bit below average. I want to say from the positive side, it's not a recession. But on the negative side, we've been waiting 4 years for what economists like to call escape velocity in the US economy, where it really takes off to high levels. And we just don't ever quite seem to get there.
And why is that?
I think it's a host of reasons. I think reason one is that in the 7th year of a recovery, which is what we are in now, inefficiencies start to creep into an economy. I also think that in the 6th year of zero interest rates, whatever benefits you've had from cheap money in the real economy has pretty much run its course right now. And it's real hard to really push that idea much further than it already has.
Jim, the jobs report that just came in recently, where the 10th of November today, was pretty strong. Markets seem to really like it, and really seems now like the Fed might pull the trigger and tighten interest rates at the December meeting. What do you think?
Well, right now the markets are pricing in a rate hike. This is, interestingly, the first time in 9 years that the markets have priced in a rate hike for the next meeting. It's barely priced in. I would guess, though, that what will make the ultimate decision on whether the Fed moves or doesn't move is whether or not the markets continue to price it in, because the Fed's got a whole complicated series of levers and stuff that they're going to be pulling when they raise rates, because it's going to be unlike any other rate hike. And I don't think they really want to have the markets fighting them at the same time. So as of today, November 10th, a rate hike is priced in. But by the time you get to December 7th, 16th, the day that they're going to move, it may be priced out.
And since the jobs report, we've seen the US dollar strengthen pretty dramatically from about a 114 or so euro dollar down to 106.80 today. Do you think that dollar strengthening is something the Fed's going to watch as well?
Yes, I think the dollar strengthening will continue. Back in the spring, when we were near levels where we are right now, everybody was in the trade that the dollar was going to strengthen, the euro was going to go to parity. We call it on Wall Street a crowded trade. They've kind of largely gotten out of that trade in the last 8 months or so, and now they're starting to get back into that trade, and I think it's going to keep going. Yes, the Fed's going to pay close attention to it. The Federal Reserve quantitative easing considers the stock market a policy tool. It has been used to try and promote higher economic growth. Anything that would disrupt that policy tool, like a stronger dollar, like higher interest rates, will be looked at very closely by the Federal Reserve.
Particularly so that company earnings are really not on the rise.
That's correct. For the 3rd quarter in a row, S&P 500 companies are going to report lower earnings than a year ago. The estimates are for the 4th quarter that that's going to happen again too. A host of reasons are causing that to happen. One is energy prices are down a lot over the last year. The energy companies are reporting huge losses. Two, about 40% of S&P 500 earnings comes from overseas, and the strengthening dollar really is a drag for those companies as well. So the earnings picture in the U.S. is still tough, and it's going to be that way for the next couple of quarters.
Jim, you're one of the preeminent fixed income and Wall Street strategists and Fed watchers out there. I mean, what's your gut feeling? Do you think at some point the Fed has to tighten? Do they lose a little bit of credibility with the markets?
I think that they've already started to lose some credibility with the markets. You can only threaten to do something for so long and then not follow through on it. The problem that the Fed has is that they want to raise rates, but they also don't want a rate hike to become very messy. So they want the markets to kind of go along with them, agree with them as well too. And to that end, the markets have been fighting the Fed a little bit. The Fed says they want to raise rates. The markets don't really price it in. And then it becomes problematic. At the end of the day, I think it's a lesser of two evils for the Fed to say we didn't move, mainly because the market doesn't have it priced in, then force a move and then create havoc because of the move. Trichet tried that in 2010. The Japanese tried it in 2006. When they first came off of zero, they kind of forced it a little bit. Their markets got a little bit wobbly, and then they were forced to backtrack off of that as well, too. I don't think the Fed wants to make that same mistake.
Mm-hmm. But if the data is really not supporting it, why does the Fed want to come out?
That's a very good question, because the data in the U.S. is, let's characterize it as okay. It's not great, it's not bad, but it's been okay for a couple of years. But the Fed's got a zeal now to raise rates. I think it's really about that they think QE has run its course, that it's done what it can for the economy, and now it's been reduced to an instrument that manipulates markets. The stock market is a policy tool. QE helps to lift the stock market. They don't want to be in the game of manipulating markets. They want to be in the game of helping the economy. So they want to get out of that by raising rates and exiting this whole operation altogether. The problem is the market kind of likes it, and it doesn't really want them to exit it, and that's kind of the push-pull that they've got between the markets and themselves about raising rates.
And I mean, in this unusual kind of new world order, the Federal Reserve, because this is the first time they're going through this, it seems like a lot of the data is almost contradictory. And what are you advising your clients? I mean, what should people do these days, especially if they have big fixed income portfolios?
Well, one of the things that they need to understand is the Wall Street saw that it's one rate hike, it doesn't matter, is a little bit of a misplaced argument, because the market doesn't have it priced in. It's not expecting it. If the Fed forces a rate hike on the market, then it could be disruptive for the markets. Or if the Fed convinces the markets it's going to go, there's going to be a big adjustment. So I've been telling people that from one standpoint, higher rates is going to be disruptive, especially for the short end of the yield curve. Interest rates that mature 5 years on in could rise. If it is disruptive, interest rates, say 10 years on out, could fall, and you could have a big steepening of the yield curve. They would fall because the disruption would lead to the potential of lower inflation, lower economic growth. The short rates would rise because they're so dictated by Fed policy that even though the economy might be experiencing instability because of a rate hike, they're still raising rates and they have to follow the interest rate market higher.
So in the end, is it going to be, as Wall Street says, hike in December and then 4 hikes next year?
Well, that is what Wall Street expects, is that they expect between now and the end of next year 5 hikes, and that the interest rate level in the United States will be 1.5% to 1.25%. I think that at the end of the day that the Fed is going to do a little bit less than that. The economy doesn't look like it's going to break out. Earnings don't look like they're going to zoom higher. Unless that happens, then the Fed would have carte blanche to move higher. But without that, I think that there's going to be a very slow go at it, and it might be a little bit messy along the way. So caution is the watchword. The markets necessarily won't give you a lot of pain. It'll be more like what we've had this year. It's the middle of November. The return in the stock market this year has been 0, no return. It's right where it started the year. I suspect by the time we get to spring or summer, we might still be at the same level, no return.
Mm-hmm. Jim, if our viewers want to keep in touch with you and get more of your words of wisdom, you have a website that you can point them to?
Yes, Bianco Research is the word, and you can go to www.biancoresearch.com or our Twitter handle @Bianco Research.
Fantastic, thanks.
Thank you.
Gentlemen, thank you very much.
Thanks, Nicolette.